Welcome to the Silver Change Chronicles. This is a safe space where we believe finances don't need to be complicated, especially when it comes to keeping more of your hard-earned money away from the taxman. Did you know choosing the wrong retirement account could cost you thousands in taxes later? Today, we are demystifying the IRA so you know exactly which one fits your wallet, whether you're an employee or running your own show. What's an IRA? IRAs are individual retirement accounts. They're a good way to save for your future tax-wise because they're considered tax-advantaged. Now, this just means there are special rules that help reduce the amount of taxes you owe either upfront or when you begin making withdrawals. IRAs are investment accounts. Think of it like a basket. You're filling it with things to invest in, such as stocks, annuities, and mutual funds. We'll explore these in another episode. You can open an IRA at most financial institutions, including online brokerages. Opening one usually costs little to nothing. Many places offer $0 minimums and setup fees, though some, of course, may charge for different things. Generally, you must have earned income to contribute to an IRA. Now, earned income typically comes from things like salary, wages, or tips from a job or self-employment. You can also add to it by rolling over money from another retirement account. These funds do not count towards any annual contribution limit. There are several types of IRAs, though they're divided into two camps, traditional and Roth. The biggest difference between the two is taxes. With traditional IRAs, you begin paying taxes at age 59.5 if you start making withdrawals. After age 73, you're required to withdraw a minimum amount each year. That age increases to 75 in 2033. You may be eligible for a tax deduction during the years you contribute to a traditional IRA if you meet certain requirements. Be advised that there are income limits. If you make $79,000 or less and meet other conditions, you may take a full deduction. Anything more than $79,000, you will need to meet certain conditions and adjusted gross incomes. There are also contribution limits. For 2026, the most you can contribute is $7,500, $8,600 if you're age 50 and up. Because the contributions are tax-free, you pay income tax on your distributions. Traditional IRAs are good for people who expect to have a lower tax rate later in life and want to avoid paying more taxes now. Now, Roth IRAs offer completely tax-free withdrawals because you've already paid taxes on the money. However, unlike traditional IRAs, you don't get a tax break on your contributions. You can also withdraw these funds at any time, though there's no requirement to do so. Be aware that anything you've earned from contributed funds is taxed unless you're at least 59.5 and the account has been open for 5 years. With Roth IRAs, the amount you make in a year and your tax filing status determines how much you can contribute. You have until April 15th, 2026 to contribute for 2025. The maximum amount is $7,000, $8,000 if you're age 50 and up. For 2026, the limit is $7,500, $8,600 if you're 50 and over. Generally, as long as you make less than $150,000, you may contribute the full amount. An adjusted gross income higher than that and your contributions may be limited. Since you pay taxes up front, Roth IRAs are good for people who expect to have a higher tax rate later in life and want to avoid paying more in income taxes. By the way, if you're still watching this video, do me a favor and drop a tree emoji in the comments. Another type of IRA is an SEP, which stands for Simplified Employee Pension. According to Bankrate, it's for small business owners and their employees or self-employed individuals. It can be set up like a traditional or a Roth IRA, and contributions are only made by the employer. The funds are then equally distributed into an SEP for each employee. By the way, employees are not allowed to add money to these accounts. Upfront tax benefits go to the employer since they're making the contributions. With traditional SEPs, you can begin taking distributions at age 59.5 with required minimum distributions at age 73. Whether it's a traditional or Roth SEP, any earnings withdrawn prior to age 59.5 are subject to a 10% tax penalty. Roth SEP owners may withdraw contributions at any point tax-free. Contribution limits are pretty straightforward. Your maximum contribution is the lesser of 25% of the employee's compensation, or $70,000. This can be very beneficial for self-employed individuals. SEPs are fairly easy to set up. Complete one IRS form, and your chosen financial institution can guide you through the last few simple steps. Be mindful, though, that there are no catch-up contributions if you're over the age of 50, as there are with regular IRAs. Additionally, per the IRS, there are a few requirements employees must meet in order to be eligible for participation. The Savings Incentive Match Plan for Employees, or SIMPLE IRA, is for self-employed individuals or small businesses with 100 employees or less who earned at least $5,000 the previous year. Simple IRAs are usually set up similar to traditional IRAs. However, as of 2026, employers may allow employees to make Roth salary contributions. Employers are required to contribute if the setup is that of a traditional IRA. However, they are not permitted to contribute to Roth plans. For employees, contributing to either plan is optional. If an employee chooses to participate and the contribution is made with pre-tax dollars, like a traditional IRA, employers may match the contribution up to 3%. Employers also have the option to contribute a fixed percentage based on the employee's compensation, at least 2%, whether the employee contributes or not. Withdrawals taken from a traditional simple IRA before age 59.5 are generally subject to a 10% penalty, with it increasing to 25% if the withdrawal occurs within the first 2 years of establishing the account. Minimum distributions are required beginning at age 73. For Roth Simple IRAs, all withdrawals are tax-free if the participant is at least 59.5 and had the account at least 5 years. Contributions are limited to between $17,000 and $18,100, depending on the number of employees. For those aged 50 and up, the limits are increased to between $21,000 and $26,250, depending on their age. There are other types of IRAs. Today, we've just covered some of the more common ones. Other types include inherited, which is an IRA funded from a deceased person's retirement plan; spousal, which allows the non-working spouse of an employed person to contribute to an IRA; self-directed, which allows the participant to own alternative investments such as real estate, gold, and privately held companies; and rollovers, which are created by transferring funds from a previous workplace savings plan into a traditional IRA. While there's no limit to the number of IRAs you can have, you are limited on the amount you can contribute each year. You cannot contribute more than the annual maximum for each specific type of IRA. If you do, you will be penalized by the IRS, and trust me when I say that those are not people you want to mess with. When it comes to funding IRAs, start small. If funds are tight, experts recommend starting with a contribution of just 1% of your income. If you have $1,000, put $10 in your IRA. Slowly increase this amount to 15% as you can. Remember, Rome wasn't built in a day. The same goes for your retirement. You can set up recurring monthly deposits from your checking or savings to your IRA, even if it's $5 or $10, or even have a portion of your paycheck or tax return deposited directly into the account. The point is, just get started. Well, that about wraps things up for today. If you haven't seen it yet, check out our video on how to read a credit report. As always, if you learned one new thing today, hit that like button. That lets me know I should keep going with this content. And if you learned 2 new things, subscribe and tell a friend. We're really trying to grow this channel and reach as many people as possible. We hope to see you here again at the Silver Change Chronicles, where we believe finances don't need to be complicated.